plans to become a bank for institutions, essentially. This is kind of the big difference. The question is, because this is moving from a speculation phase that they've been involved in to an infrastructure phase, because this license isn't about putting, pumping price tomorrow. It's really about kind of cementing XRP and RLUSD as a federally regulated stable settlement rail. So if you've got a federally regulated settlement rail, then you look at this historic run on gold right now of what we're seeing. It almost...
When people say Grayscale insiders are predicting a crypto boom, what they're really reacting to isn't a leaked memo or a bold promise. It's a shift in posture. And posture tells you more than predictions ever will. Grayscale doesn't speak like retail. It never has. They don't chase headlines. They don't need excitement. Their job isn't to be early on hype. Their job is to survive cycles, attract long-term capital, and position where capital eventually flows.
We'll see where that goes in Congress, and so I'm hoping that they'll be able to get that through. But in the meantime, we in the CFTC will be in RDR, actively.
So when names like XLM, XRP, HBAR, and XDC keep appearing in the same institutional conversations, the signal isn't urgency. It's selection. This is where most people misunderstand what a crypto boom actually means in institutional language. Retail hears boom and imagines candles, screenshots, overnight wealth. Institutions hear boom and think reallocation. Capital moving quietly from inefficient systems into efficient ones. Slowly at first, then all at once. That's the kind of boom that doesn't trend until it's already underway. Grayscale insiders aren't predicting excitement. They're recognizing pressure. Pressure in global finance. Pressure in settlement systems. Pressure in regulation, compliance, and cost. And pressure always looks for the path of least resistance. That's where XLM, XRP, HBAR, and XDC come in. Not because they're loud, but because they're boring in the right ways. Each of these assets solves a specific institutional problem. XRP focuses on cross-border liquidity and settlement efficiency. XLM leans into accessibility and low-cost global transfers. HBAR prioritizes enterprise-grade stability, governance, and throughput. XDC targets trade finance and real-world business settlement. Different lanes. Same destination. Efficiency. This isn't coincidence. Institutions don't diversify narratives. They diversify use cases. When you see these assets grouped together, it's not because someone expects them all to moon at once. It's because they collectively map onto the future plumbing of finance. Grayscale doesn't need to announce a boom for this to matter. Their actions do that quietly. Watch what gets researched. Watch what gets framed as infrastructure. Watch what gets treated as long-term exposure rather than short-term trade. Those are tells. Another thing people miss is timing psychology. Institutions position when things feel unresolved. When regulation isn't perfectly clear. When price action is frustrating. When retail interest fades. That's not a flaw in their strategy. That is the strategy. Because by the time clarity arrives, asymmetry disappears. This is why insiders talk about cycles differently. They don't ask, is now the bottom? They ask, is the system being rebuilt? And right now, the answer to that second question is quietly becoming yes. Legacy systems are expensive. Settlement is slow. Liquidity is inefficient. Compliance is fragmented. Those problems aren't theoretical anymore. They're operational pain points. And capital doesn't argue with pain. It adapts. That's why the idea of a crypto boom tied to assets like XLM, XRP, HBAR, and XDC feels strange to retail. There's no mania yet. No mass excitement. No mainstream celebration. Just silence. But silence is where institutions work best. This isn't about predicting a date. It's about recognizing preconditions. When infrastructure assets start being grouped, studied, and framed together by institutional players, it usually means one thing. They're preparing for a world where efficiency matters more than novelty. And in that world, the biggest moves don't start with hype. They start with quiet conviction. In this video, we're going to break down why these specific assets keep appearing in institutional frameworks, what problem each one solves, and why the market consistently underestimates how fast capital can move once pressure crosses a certain threshold. Because when the boom finally becomes obvious, it never feels like it started where people think it did. Let's break this down carefully, because this is where most people completely misunderstand what a crypto boom actually looks like from an institutional perspective. When Grayscale insiders talk about a potential boom in assets like XLM, XRP, Hbar, and XDC, they aren't thinking in terms of overnight gains. They're thinking in terms of structural positioning. That's a concept retail rarely considers. Markets don't move because of hype. They move because systems realign and capital flows into efficiency. Efficiency is boring until it suddenly isn't. And that's exactly what these four assets represent. XRP has been consistently highlighted in institutional conversations for one reason: cross-border settlement efficiency. Traditional banking systems tie up trillions of dollars in pre-funded accounts. That's idle liquidity. It's risk sitting there unnecessarily. XRP solves that by acting as a bridge asset, enabling near-instant settlement between different currencies. It's not flashy, but it's operationally transformative. For institutions, operational transformation is the definition of value. XLM focuses on accessibility and low-cost transfers. While XRP solves liquidity and settlement in heavy corridors, XLM is the lightweight, inclusive alternative for remittances and smaller-scale transfers. Institutions like to cover all bases, big corridors and microflows, and XLM fits perfectly into that niche. Its design emphasizes simplicity and reliability, which aligns with regulatory requirements and reduces operational friction. Hbar, Hedera Hashgraph's native token, is attracting attention because of its enterprise-grade stability. Unlike many other blockchains that are experimental, Hbar offers predictable governance, high throughput, and low latency. Institutions view this as crucial. Predictability in enterprise operations translates to lower risk. And lower risk means larger positions can be allocated with confidence. In other words, it's a playground for big money because it's engineered to scale without surprises. XDC or XINFIN is slightly different, but it complements the others. It's built for trade finance and real-world business settlement, which bridges crypto innovation with tangible economic activity. While XRP and XLM handle payments and liquidity, XDC focuses on enabling actual commercial processes, like invoices, supply chain finance, and cross-border trade contracts. That makes it appealing to institutions looking to anchor crypto strategies in concrete business applications. Here's the pattern. Each asset solves a unique operational problem, yet together they form a coherent institutional strategy. Grayscale insiders are not predicting a random surge. They're predicting that when systems are ready to adopt more efficient rails, these assets will naturally capture the value that flows into them. The current market is underestimating this because retail measures progress in short-term excitement. Price spikes, news cycles, and viral hype. Institutions measure progress in adoption readiness, integration, and friction reduction. That's why these assets may feel quiet to the average trader, even though systemic adoption is occurring behind the scenes. Another factor is regulatory clarity. Institutions don't gamble in uncertainty. XRP's legal journey, XLM's focus on compliance-ready transfers, Hbar's governance model, and XDC's business-oriented structure all minimize regulatory risk. That makes these assets far more appealing to entities managing millions or billions in capital. They aren't chasing price. They are chasing certainty of operational reliability. Liquidity corridors are another critical piece. Institutions look for where value can move efficiently without excessive slippage or exposure. XRP acts as a bridge in big corridors, XLM in lighter corridors, Hbar stabilizes enterprise flows, and XDC links real-world contracts to crypto value. Together, these corridors form a resilient framework, which is exactly the kind of infrastructure Grayscale insiders monitor closely. Timing also matters. Institutional adoption moves slowly, deliberately, and often quietly. Pilots precede large-scale integration. Testing precedes deployment. Adoption precedes price recognition. By the time retail notices, the structural groundwork is already complete. That's why the insider's prediction is meaningful. They are observing preconditions, not fireworks. Finally, these assets collectively represent diversified exposure to systemic improvement in crypto infrastructure. They aren't being chosen because of moonshot potential. They are being chosen because they are built to handle real problems at scale. That makes them prime candidates for a surge when market recognition finally catches up. Next, we'll examine how these structural shifts translate into market behavior, why delayed price recognition is common, and what indicators holders should watch to understand when institutional alignment turns into a visible boom. Because when efficiency becomes obvious, the market rarely moves slowly. Now we move into the heart of the matter: how institutional positioning in assets like XLM, XRP, HBAR, and XDC translates into what retail experiences as a crypto boom. Understanding this requires shifting your perspective from price to function. Retail looks at charts. Institutions look at throughput, risk, and readiness. The difference explains why these assets appear quiet, even when serious adoption is underway. Take XRP as an example. Its utility isn't speculative. The strength is operational. Settlement speed, liquidity efficiency, and counterparty risk reduction are measurable factors for institutions, not the emotional highs and lows of retail traders. When an institution evaluates XRP for cross-border transactions, the question isn't, will the price moon? It's, will this reduce friction, capital tie-ups, and operational risk? The answer is yes, and that reliability is what makes XRP consistently appear in strategic conversations. XLM follows a similar logic but in a different lane. While XRP focuses on heavy liquidity corridors, XLM is designed for accessibility and inclusion, especially for smaller, frequent transfers. Institutions interested in remittances, micropayments, or emerging markets see XLM as a bridge to untapped opportunities. Its low-cost, low-friction design makes it operationally safe and scalable, which is exactly the kind of reliability big capital prefers. HBAR adds enterprise-grade stability into the mix. High throughput, governance predictability, and fast finality make it a rare crypto asset ready for corporate integration. Unlike most blockchains, HBAR was engineered to survive stress tests, regulatory scrutiny, and high-volume transactions without faltering. Institutions don't want excitement, they want predictable outcomes. That's why HBAR is repeatedly mentioned in strategic planning sessions as a tool for large-scale adoption. XDC complements the ecosystem by targeting real-world business and trade finance solutions. It's not just about moving money. It's about anchoring blockchain functionality to tangible economic activity, supply chains, invoices, and international contracts. Institutions see XDC as a practical entry point to integrate crypto into existing workflows. This reduces the cognitive and operational gap between traditional finance and blockchain systems, making adoption smoother. When you map all four together, XRP, XLM, HBAR, XDC, you see a portfolio of operational solutions covering major points of friction in global finance. XRP, cross-border liquidity efficiency. XLM, accessible low-cost transfers. HBAR, enterprise-grade transactional stability. XDC, business and trade finance integration. That is not random. That is systematic preparation for structural adoption. The current market often misses this because retail perception is time-compressed. Traders want immediate confirmation through price spikes. Institutions operate on multi-year horizons. Pilot programs, liquidity testing, and compliance alignment happen quietly. By the time price reflects the underlying adoption, the groundwork has already been done for months, sometimes years. This explains the apparent flat or boring market periods. Far from being dead zones, these are consolidation phases where systems are being stress-tested and optimized. Institutions are quietly building positions, testing corridors, and ensuring that once adoption scales, the network can handle the load. Another critical factor is regulatory certainty. XRP's long legal exposure has provided clarity that many other assets lack. XLM's focus on compliance-friendly design Hbar's predictable governance, and XDC's real-world application all reduce the risk profile for large capital deployment. Institutions will only commit heavily once risk is manageable. This is why insiders like those at Grayscale are watching these assets closely. They are readying for a market where risk-adjusted opportunities finally align. Liquidity corridors play a subtle but critical role. XRP and XLM form complementary lanes for value transfer, while Hbar and XDC stabilize enterprise and trade operations. Once these corridors function smoothly at scale, price must adjust, because utility has been realized at an institutional level. This is why surges are often abrupt. They represent delayed recognition of previously established adoption. Understanding this framework explains why so many retail narratives fail. Price movements appear disconnected from news because the news being acted upon is operational, not sensational. Systems are being rebuilt behind the scenes, quietly accumulating efficiency, trust, and utility. When the market finally acknowledges this, the boom appears sudden, but in reality, it is the result of months or years of methodical, silent groundwork. Finally, we'll tie this into what it means for holders today, how to interpret these quiet phases, avoid hype traps, and position strategically for when the institutional alignment transforms into visible market momentum. Because the true opportunity lies not in chasing the surge, but in understanding the systems that create it. The Grayscale insiders aren't hyping a pump. They're signaling structural opportunity. When you hear talk about XLM, XRP, Hbar, and XDC, it isn't about overnight excitement. It's about preparedness, efficiency, and reliability. That's why these assets consistently appear in institutional analysis. They solve different operational problems, but together they map a coherent strategy for global capital flow. Right now, the market may look quiet. Price charts may feel stagnant. Retail narratives may obsess over short-term volatility. But silence is not inactivity. It's consolidation. It's infrastructure being stress-tested, corridors being readied, and adoption quietly scaling. This is the calm before the boom that really matters, not hype-driven pumps, but systemic repricing driven by real-world usage. Understanding this shift changes everything. The opportunity isn't in guessing the day or exact price. It's in recognizing preconditions. The alignment of adoption, liquidity, regulatory readiness, and interoperability. XRP prepares corridors. XLM readies accessible flows. Hbar stabilizes enterprise transactions. XDC links crypto to tangible trade. Institutions watch these signals. When readiness reaches critical mass, price catches up, often suddenly. This is why patience is your greatest asset. Most retail traders can't endure the boredom of structural alignment. They demand instant gratification. Institutions thrive in it. By the time the market reacts visibly, those who recognized the underlying framework first have already positioned advantageously. If you're holding or planning to hold these assets, focus on what matters most: usage, adoption, and functional integration. Ignore noise. Don't chase headlines promising a surge. Instead, watch for the slow, quiet signals that indicate systems are aligning and adoption is scaling. That's where the true boom begins. Here's what to do next. Pay attention to liquidity corridor expansions, cross-border settlement integration, enterprise adoption announcements, and regulatory clarity. These are the real precursors to market repricing. When these signals converge, the boom will feel sudden, but in reality, it was already building quietly, silently, and efficiently. If this breakdown helped you see through the noise, hit the like button to support content that focuses on structure over hype. Subscribe for more deep dive analyses into crypto's underlying systems and comment below. Which of these four assets, XLM, XRP, Hbar, or XDC, do you think is currently the most underappreciated by the market? Your insights could spark a discussion that helps others see the real signals amidst all the noise. Remember, the market moves fastest when most people are distracted by noise. The true advantage comes from understanding the systems that create momentum and patiently positioning before the world catches on.